everyone, welcome to Panacea Tutor. Today in this video we are going to discuss three topics: financial inclusion, non-banking financial company and development finance institution. These three topics are newly added topics in your banking and financial institution subject. So in this video we will discuss all these three topics. Now we will begin our discussion from our first topic, financial inclusion. What do you mean by financial inclusion? Financial inclusion is described as the method of offering banking and financial solutions and services to every individual in the society without any form of discrimination. It basically aims to include everybody in the society by giving them basic financial services without looking at a person's income or savings. Financial inclusion focuses on providing reliable financial solutions to the economically underprivileged sections of the society without having any unfair treatment. It intends to provide financial solutions without any signs of inequality. It is also committed to being transparent while offering financial assistance without any hidden transaction or cost. Financial inclusion wants everybody in the society to be involved and participate in the financial management judicially. So what do you mean by financial inclusion? It means basically the process of ensuring the access to financial services, access to banking services to all. The primary target of financial inclusion is that all the vulnerable groups of the society, that is the weaker section of the society, can be given the best financial services at low cost and at an affordable cost. It basically includes pricing of financial services at an economical cost. Now the important point under financial inclusion is that it not only includes the banking product, but it also includes the insurance product, the equity products. Now I have mentioned one word, that economically underprivileged people are given preference under financial inclusion. Now why this happens? These economically underprivileged people of the society may not have the proper documents, they may not have the available resources with them to buy the financial services. And also every bank requires proper documentation to provide them credit. Every bank has certain mandatory documents that need to be furnished during a loan application process or during a bank account creation process. Many of these people do not have knowledge about the importance of these documents. They also do not have access to apply for government sanctioned documents. Financial inclusion basically aims to eliminate these barriers and provide economically priced financial services to the less fortunate sections of the society so that they can be financially independent without depending upon charity or other means of getting funds. The other important point under financial inclusion is that it also aims to spread awareness about financial services, financial management and about the banking services among the society. Moreover, it wants to develop formal and systematic credit avenues for the poor people. See, in nutshell, if you want to understand the meaning of financial inclusion, the first objective under financial inclusion is provision of banking services to all without any discrimination, and also spreading banking awareness and also helping the vulnerable groups of the society to be available with the different kind of financial services which are available for them. What are the objectives of financial inclusion? Financial inclusion intends to help the people to secure financial services and products at economical prices such as deposits, fund transfer services, loan application services, insurance, payment services, etc. The next objective of financial inclusion is to establish proper financial institution that will cater to the needs of the poor people. The third objective is financial inclusion aims to build and maintain financial sustainability so that less fortunate people have a certainty of funds which they struggle to have. The next objective is it intends to have numerous institutions that will offer affordable financial assistance so that there is sufficient competition so that clients have a lot of options to choose from. The next objective of financial inclusion is to improve the financial literacy and financial awareness in the nation. The next objective is it aims to bring in digital financial solutions for the economically underprivileged people of the nation. See, financial inclusion is a new term added in your syllabus. So, there are many chances that question can be asked from this topic. Now, there are some recent government initiatives for financial inclusion. Basically, under financial inclusion, government has taken many initiatives so that banking services can be provided to each and everyone. The first such initiative is spread of ATM. ATM are spread everywhere. Anyone can withdraw money anywhere whenever he wants, and ATMs also provide the services of 24 hours. The next government initiative is, as you can see on your screen also, Integra's Mobile Financial Application Secure Terminal. The trick to remember this full form is IMFAST. IMFAST. What is this? Now, this scheme extends banking services to financially excluded rural India. It means to all those rural areas which are not covered by the banks, which are not provided the finance properly. The next such government initiative is White Label ATM. See, what are White Label ATM? White Label ATM means provision of ATM services by non-banking financial corporations. It means provision of ATM services by all those organizations which are not banking companies. So this is one of the initiative taken to promote financial inclusion. The Government of India has permitted non-banks to set up, own and operate ATMs so that to increase the growth and penetration of ATMs in the country. The next initiative under the financial inclusion is business correspondents. Business correspondents are the people which are appointed by bank and who will personally go to the villages and will collect money from them and will deposit into the bank. So they are the people who will go to villagers, will make them aware about the different banking services, will collect their money from them and will make a bank account for them and will deposit their money in that account. So these are some of the government initiatives taken to promote financial inclusion. Our next newly added topic in the banking subject is Development Finance Institution. What are Development Finance Institution? See, first of all, you all must know that the other name for Development Finance Institution is the Development Bank or a Development Finance Company. What are Development Finance Institution? These are specialized institutions which are set up primarily to provide development or project finance, especially in developing countries. These development banks are usually majority owned by national governments. I have mentioned the word majority owned. It doesn't mean that private companies cannot own the development finance institution. They can own it, but majority of the development finance institution are owned by the national government. The source of capital of these banks is national or international development funds. So basically, development finance institution are the institution that provide the finance for the development of the country. Their main purpose is the development of the country. That's why they are known as development finance institution. Development finance institution invest in private sector projects in low and middle income countries to promote job creation and sustainable economic growth. They apply stringent investment criteria aimed at safeguarding the financial sustainability, transparency, environmental and social accountability. The next topic under Development Financial Institution is classification of development finance institution. See, the development finance institution are classified on 4 bases. The first one is National Development Banks. National Development Banks means the banks which operate on a national level. Now, what kind of banks are included under this? IDBI, that is Industrial Development Bank of India, ICICI, IFCI, IRBI and IDFC. These all banks are the National Development Banks. The full form of the same you can see on your screen. The second one are specialized or sector specific banks. It means these provide development finance to specialized sectors or to a particular sector. Now, what does it include or what kind of banks are included under this? The first one is the Exim Bank. Exim Bank is the Export-Import Bank of the country. NABARD Bank, the HDFC Bank, the National Housing Bank and the TFCI Bank. The next classification of development finance institution is the investment institution. Investment institution means the institution whose main purpose is of investment. That is, their main motive is that investors come into these banks and invest for a long time. So what kind of institution are included under this? The first one is LIC, Life Insurance Corporation, GIC, General Insurance Corporation. Third one is UTI, that is the Unit Trust of India. The fourth one is state level institution. State level institution means the development finance institution which operate on a state level. What does it include, or what kind of banks are included under this? That is State Financial Corporation or State Industrial Developmental Corporation, that is SIDCS. See, what is important, you must know what kind of banks are included under development finance institution, and you should also know in which year all these banks came. See, for example, Exim Bank came into existence in 1982. NABARD came into existence in 1981. IDBI came into existence in 1964. SIDBI came into existence in 1990. ICICI came into existence in 1994. IFCI came into existence in 1948. And you must also know this is very important, that the first ever development finance institution which was set up in India was IFCI, that is Industrial Financial Corporation of India. It was set up in 1948. And the second development finance institution was State Financial Corporation. That is, it means this development financial institution was set up for the state level for the small purpose for medium-sized financial corporations. It was set up in 1951. And also one important year to remember under development finance institution is the year of 1955. In 1955, the first development finance institution in private sector along with ICICI with the backing of World Bank was set up. One important point under development finance institution is that during 2002 to 2004 period, ICICI and IDBI were turned into commercial banks. So in the present era or in the present date, the line between the role of development financial institutions and the commercial banks have blurred. It is because of the overlapping of their functions. Nowadays, the commercial banks are actively involved in the development of financing similar to development finance institution, because nowadays commercial banks have also started providing the finance for the development of the country. Our next newly added topic is non-banking financial companies. What are non-banking financial companies? See, I will make you understand non-banking financial companies with the help of some of its important features. By studying the important features, you will understand that what are non-banking financial companies. First of all, you must know that non-banking financial companies are the companies which are registered under the Companies Act 2013. They do not require licenses from RBI, although they perform the banking services, but they do not require the licenses from RBI. What are non-banking financial companies? Non-banking financial companies are the companies which are engaged in the business of loans and advances, acquisition of shares, bonds, debentures issued by the government or local authority, or other marketable securities like leasing, hire purchase, insurance business, but it does not include any institution whose principal business is that of agricultural activity or industrial activity. It does not hold a bank license because it does not require any licenses from RBI. Now we will discuss some of the features of non-banking financial companies which will help you in understanding that what are basically NBFCs. Non-banking financial companies cannot accept demand deposits. Also, these companies do not require any CRR, that is cash reserve ratio, SLR, statutory liquidity ratio. Also, deposit insurance facility is not allowed under NBFCs. Deposit insurance facility is the facility which is normally provided under all the banking services. It is provided by the Deposit Insurance and Credit Guarantee Corporation. So question can be asked from here, who provide deposit insurance facility? Deposit insurance facility is provided by Deposit Insurance and Credit Guarantee Corporation, and this facility is not provided under NBFCs. Also, NBFCs cannot offer the interest rate higher than the ceiling rate as prescribed by RBI from time to time. NBFCs must have a minimum investment grade credit rating. This means NBFCs must have a rating from a recognized credit rating agencies. Also, RBI does not give any guarantee of the repayment of deposit under NBFCs. NBFCs cannot offer gifts, incentives, or any additional benefit to the depositors. NBFCs are allowed to accept or renew the public deposits for a minimum period of 12 months and for a maximum period of 60 months. By studying all these characteristics, you can now understand that what are NBFCs, what are non-banking financial corporations. These are basically the corporations which provide the banking services, but they do not hold a bank license from RBI. Also, RBI does not give any guarantee of the deposits made under NBFCs. Also, NBFCs cannot accept the demand deposits. So these are some of the features of NBFCs which differentiate them from other commercial banks. Now there are different types and categories of NBFCs, means what kind of NBFCs exist in our country. The asset finance company, it means the company which provide finance for the purchase of asset. The infrastructure finance company, it means the finance company which provide finance for infrastructure projects. The equipment leasing company, it means the company which provide the finance for leasing of equipment. The next is housing finance company. Housing finance company means the finance company which provide finance for housing purpose, that is for the purchase of residential houses. One important point that you must remember under non-banking financial companies is that they were given the name of shadow banks in the year 2007. This was all about all the three topics. See, these three topics are newly introduced in your syllabus by NTA. There are many chances that question can be asked from these three topics. These topics are very important. Thank you everyone. If you like our video, please subscribe our channel and do hit the bell icon. And if you want to avail the full courses of UGC Net Management and Commerce, you can contact us on the given mail ID and you can even WhatsApp us or call us on the given phone number.